Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of discussion is how to deduct the rent you pay yourself from your LLC in the US home office hack. So what are the home office deductions? Uh, Talking about this point of we will first take its overview setting up a home office, discover the important tax implications, and learn how to claim the home office deductions if you work from home. Maximize your tax benefits by understanding the rules and the requirements. So, what are the new tax law changes? The one big beautiful bill that passed includes permanently extending tax cuts from the Tax Cuts and Job Acts, including increasing the capital on the amount of state and local or sales tax on the property tax that you can deduct, makes cuts to the energy credits passed under the Inflation Reduction Act, makes changes to tax on tips and overtime of certain workers, reform Medicaid, increases the debt ceiling and reforms Pell Grants, and then student loans. Update to this article are in process, so check our one big beautiful big bill article for more information. So what the table of content creates contains, do I qualify for the home office tax deductions? If I am self-employed, should I take home office tax deduction, or what's the exclusive use? So talking about the key takeaways, the first one is you may qualify for the home office deduction if you use a portion of your home for your business on a regular basis. A home can include a house, apartment, condominium, or the mobile home, boat, or a similar structure. Generally, your home office must be either the principal location of your business or a place where you regularly meet with customers or the clients, and you usually must use the area exclusively for your business. The rate for the simplified square footage calculation is $5 per square foot, with a maximum of the 300 square foot. So if you care for children in a portion of your home, using that part of the house for personal activities the rest of the time typically allows you to still claim the business deductions. Now that many of us working remotely, you may be wondering whether working from home will yield any tax breaks. If your small business qualifies you for a home office tax deduction, should you be concerned about triggering an audit? How does a business qualify in the first place? This article will dive into the most common questions about this tax deduction. So, do I qualify for the home office tax deductions? Generally speaking, to qualify for the home office tax deductions, you must meet one of these criteria. So, the first criteria is exclusive and regular use. You must use a portion of your house, apartment, mobile home, boat, or similar structure for your business on regular basis. This also includes structures on your property such as an unattached studio, barn, greenhouse, or garage. It doesn't include any part of our taxpayers' property used exclusively as a hotel, motel, inn, or similar business. So the second criteria is principal place of business. Your home office must be either the principal location of your business or a place where you regularly meet with the customers or the clients. Some expectations to this rule include daycare and the storage facilities. So what is the TurboTax tip in this case? If you are an employee who receives a W-2 form from your employer each year, you can't claim the home office deduction for expenses related to the job, even if you work from home all the time. However, you might be able to claim the deduction if you run a side business from your home. So, if I am self-employed, should I take the home office tax deduction? You may have heard that taking the home office deduction sends a red flag to the IRS and ups your chances of being audited. So although there are many may have been some merit to this advice in the past, changing in the tax rules in the late 1990s made it easier for the people who work out of their homes to qualify for these write-offs. So if you qualify, by all the means take it. So what is the exclusive use? The biggest road block to qualifying for these deductions is that you must use a portion of your home exclusively and regularly for your business. The law is clear, and the IRS is the serious, but the exclusive use requirements say you set aside a room in your home for a full-time business, and you work in it for 10 days, 10 hours a day, 7 days a week. If you let your children use the office to do their homework, you violate the exclusive use requirement, and the forfeit the chance of for the home office deduction. The exclusive use doesn't means you are forbidden to make your personal phone call from the office. You have to rush outside whenever a family member needs a moment of your time. So although individual IRS auditors may be more or less strict on this point, some advisors say you meet the spirit of the exclusive use test as long as personal activities invade the home office no more than they would be permitted in an office building. The office can also be a section of a room, and you can show that personal activities are excluded from the business section. So what is the regular use? There is no specific definition of what constitutes regular use. Clearly, if you use an otherwise empty room only occasionally, so and its use is incidental to your business, you had failed this test. If you work in the home office a few hours or so each day, however you might pass, this test is applied to the facts and the circumstances of each case the IRS challenges. So, what does principal place of business means? In addition to passing the exclusive and regular use test, your home office must be either the principal location of that home business and of that business, or a place for regular customer or the client meetings. If your home office is in a separate unattached structure, the detached garbage converted into an office, for example, you do not have to meet the principal place of the business or the deal with the client test. As long as you pass the exclusive and the regular use test, you can qualify for home business write-offs. So what if your business has just one home office, but you do most of the of your work elsewhere? Remember that the requirements is that your home office is your principal place of business, not your principal workplace. As long as you use the home office to conduct your administrative or the management course, and you don't make substantial use of any other fixed location to conduct those tasks, you can pass this test. If you are employee of another company but also have your own part-time business based in your home, you can pass this test even if you spend much more time at the office where you work as an employee. So this rule makes it much easier to claim home office deductions for individuals who conduct most of their income earning activities somewhere else. So what qualifies as a business? As with the regular use test, whether your endeavors or qualify as a business depends on the facts and the circumstances. The more substantial to activities in terms of time and the effort invested and income generated, the more likely you are to pass the test. Making money from your efforts is prerequisite, but for purpose of this tax break, profit alone isn't necessarily enough. So if you use your den solely to take care of your personal investment portfolio, for example, you can't claim home office deductions because your activities as an investor don't qualify as a business. So taxpayers who use a home office exclusively to manage rental properties may qualify for home office tax status, but as property manager rather than investors. So what if I operate a children or storage facility. The exclusive use test doesn't apply if you use part of your house to provide. The first point is to provide daycare services for children, older adults, and the individual with disabilities. If you care for children in your home between 7 a.m. to 6 p.m. each day, for example, you can use the part of the house for personal activities the rest of the time, but and still claims business deductions. To qualify for the tax break, your home care business must meet any applicable state and local licensing requirements. So the second point is to store product samples or the inventory you sell in your business. Assume your home based business is the retail sale of home cleaning products and that you regularly use half of your basement in to store inventory. So occasionally using that part of the basement or to store personal items wouldn't cancel your home office deductions. To qualify for this exception, your home must be the principal location of your business. So how do I calculate the home office tax deductions? Your home office business deductions are based on either the percentage of your home used for the business or a simplified square footage calculation. So the most exact way to calculate the business percentage of your home or the house is to measure the square footage devoted to your home office as a percentage of the total area of your home. If the office measures 150 square foot, for example, the total area of the house is 1200 square foot, your business percentage would be 12.5%. So an easier calculation is acceptable if the rooms in your home are all about the same size. In that case, you can figure out the business percentage by dividing the number of rooms used in the business by the total number of the rooms in the house. Special rules apply if you qualify for home office deductions under the exception to the exclusive use test. So your the first point is your business use percentage must be reduced because the space is available for personal use part of the time. To do that, you compare the number of hours the child care business is operated, including preparation and cleanup time, to the total number of the hours in the year. So assume you use 40% of your house for a daycare business that operates 12 hours a day, 5 days a week for 50 weeks of the year. So 12 hours multiplied by 5 days multiplied by 50 weeks is equal to 3000 hours per year. So 3000 hours per year will be divided by 8760 total hours in the year would be equal to 0.34, that is equal to 34%. 34% of available hours multiplied by 40% of the house used for the business is equal to 13.6% business write-off percentage. What is the simplified square footage method? Beginning with 2013 tax returns, the IRS began offering simplified option for claiming the deductions. So this new method uses a prescribed rate multiplied by the allowable square footage used in the home. The first point is the prescribed rate is $5 per square foot with a maximum of 300 square foot. If the office measures 150 square foot, for example, then the deduction would be $750. The space must still be dedicated to the business activities. So which method should I use to calculate my home office deductions? The simplified method I can use that can be used to make it easier for you to claim the deductions but might not provide the with the biggest deduction. TurboTax makes it easy to determine if you qualify and how much you can write off, asking you simple questions about your unique tax situation. So more talking about this, can I live in my LLC rental property? Are you wondering if you can enjoy the privacy and the comfort of living in a property owned by your business? Many investors ask this question. Imagine leveraging the legal and the financial benefits of an LLC while residing in your investment property. The idea combines the best of the both worlds, asset protection and the personal convenience. So with the right structure, achieving asset protection and while tapping into the tax benefits and making your investment your home is possible. So navigating this path requires insights and careful planning. So read on to explore how to successfully reside in a property your business entity owns, adhere to legal standards, and optimize your investment. So understanding the basics of a limited liability company for rental property, understanding the basics of limited liability companies for rental property involves recognizing the unique blend of legal protections, tax advantages, and the operational flexibility they offer real estate investors. An LLC serves as a legal entity separate from its owners, providing a shield for personal assets against the liabilities associated with property invest activities. So the same protection means that the personal assets of the business members remain protected in the case of legal disputes or debt obligations tied to the rental property. So let's discuss the key benefits. The first benefit is liability protection. The business structure primary advantage is the safeguarding of the personal assets. Should your rental property face a lawsuit or a financial claims, the LLC structure limits liability to its assets and not its members' personal assets. So, what is the tax flexibility? LLCs often benefit from pass-through taxation, where profit and losses of the business are passed through to the individual members to tax return, avoiding the double taxation corporation can face. This can lead to the potential tax savings and simplifies the tax filing process. What is the operational flexibility? LLCs require fewer formalities and less paperwork than corporation. There's no need for a board of directors, shareholder meetings, and the annual reports in many jurisdictions, making it more straightforward structure for managing rental properties. So, what is the professionalism? Owning rental properties through an LLC can enhance your professional image among the tenants and the business partners. It signals that your rental business is a serious and the properly structured venture. So, what is the ease of ownership transfer? Transferring ownership of a property can be simpler with an LLC. Since the property is owned by the company, membership interest in the LLC can be transferred without needing to transfer the property title directly, bypassing some of the complexities and cost associated with the rental estate transactions. So residing in your LLC owned property, is it possible? After understanding the basics and benefits of owning your rental property through an LLC, let's examine the burning question. Can you live in your LLC owned property? The answer is yes, but with some caveats. So as a business owner, you can buy a house with your LLC and legally rent it to yourself, but hold your horses. It's not as that simple as packing your bags and moving in. You need to treat carefully and take certain measures such as reporting taxable income to ensure personal liability protection. Then residing in an LLC owned property can be a balancing act. So on the one side, you have the potential benefits of the asset protections and the tax advantages, but on the other hand, as compared to this, you have the risks of potential conflicts with the business purpose of the LLC and the complex tax implications. So you need to balance your personal interest with the business purpose of the LLC and ensure that your personal use does not constitute a misalignment of the interest that could be seen as a fraudulent activity. So potential conflicts with the business purpose: using your personal property for personal resident without appropriate compensation can conflict with it intended business use, posing legal risk. To avoid these issues, formalize personal use by paying market rate rent just as an external tenant would. This approach ensures alignment with a property's business objectives with legal residing there. So that was all about the topic, that how you can deduct the rent you pay yourself from your LLC in the US. So hope this topic will have been beneficial for you. So do subscribe the channel for more informative videos.